Why is that an asset rather than a liability?
Because you've already paid.
The term that I was looking for was a reduction in liability. Remember the theoretical definition of revenue? It's an enhancement of asset value or a reduction in liability value. Depreciation of intangibles is amortization. Amount due to bank on debt. Oh, we had that one in here.
Interest that we pay out there. That's an expense.
Current portion of bank loans payable.
Amount due to bank on debt, principal,
Yeah, I don't know, we added that in there, I don't know why, there was another one in here, let's get rid of that. There's another one in here that we were getting confused with. Amount of tax payments deferred, that would be balance sheet. Deferred tax liability, would that be it? Amount of tax payments deferred, 1,000.
Current portion, current income tax liability.
Current income tax liability, okay. Amount of taxes to be owed.
Current income tax.
Yeah, I think we got that wrong. So let's go back over here. Amount of tax payments deferred. That's deferred income tax. 1,000. Come on. So we've got the current tax liabilities and the deferred tax liabilities. So we have current and deferred, right? Over here, we have amount owed, and that's amount deferred, right? So there should be deferred tax. Everybody agree with that?
I think these things should be printed out.
Should we print it out?
Yeah, it's confusing when you keep having to.
So what's the difference between
Please.
the deferred, the two things you're just working on, the deferred, non-tax deferred and other liability?
Right, so we've got, so here's the current income tax liability,
Oh, okay.
and then we have the deferred tax
Got it,
liability,
that's
right?
what I'm going
And so on the deferred, this would be things like net operating losses, right? Although that wouldn't be a liability,
Credit.
right?
The tax credit.
Right. So a deferred tax liability would be,
You haven't paid your taxes.
no, it would be, I would think it would be, for instance, let's say that you invest in some securities, and the securities go up in value, and you've incurred capital gains. You haven't incurred them, but you have potential capital gains. Okay?
Must you put it on your? Yeah,
Sure.
you should, yeah.
Right? If you didn't put that, you'd be overstating the value of your balance sheet. So, look, I think the secret behind this is that you just, play around with the terms, get more familiar with them, You've heard of the expression, a flood of pleasant memories. I don't know if you are having a flood of pleasant memories, but, you know, this is the kind of stuff you want to refamiliarize yourself with, right? It will be variable with these companies. I've worked with companies where, you know, they introduce you to their accountants, and the accountants walk you through the financial statements that they've done, and they ask you if you have any questions, and it's kind of like personalized auditing, right? You know, can you show me the documentation for this, or can you tell me how you arrived at this number? And they're really very helpful, right? Another group of people, they just don't have their numbers together, okay? And, you know, they can tell you how much they bought a building for, or they can tell you what a contract they've signed with a Chinese manufacturer is, or they can tell you how much they've committed to, you know, paying their salesmen, or it's just, you know, these guys are guys who kind of, their minds work by dealing with problems right in front of them, right?
Right.
And accounting is really about methodically keeping track of what you're doing. These just aren't methodical people.
When you value a business, I mean, like, even like, plant property equipment, do you get an external valuation on the, like, for instance, land, building, thing, rather than relying on book value? Because, I mean,
Well, book value is the end result of taking all of the individual judgments the CPA has made, and cumulatively, that's how much the company's worth based
but,
on.
I mean, like the plant, I mean, sometimes they do not revise it
Are
as
you talking
often
about
as.
marking the market or something?
Yeah. Like the current value rather than.
You
the
could, but I mean,
previous-
rarely are you going to be buying into a company because of its asset value. You're buying into a company because of its operating results, right? That's why I said so
No,
much.
and I said it's, like, for instance, McDonald's, it's actually real estate. I mean, the main asset value is actually, it's real estate and,
There are certainly situations like that. There was just one in Paris where a retailer got bought out and basically shut down so that they could get access to land underneath,
yeah.
the value of it. But
So
what I'm
of course,
saying
when you sell it, then you are,
look, that's real estate investing,
yeah.
okay? In private equity, generally, I mean, some people call real estate private equity because it's not registered with the SEC, okay? Generally, when you're talking about private equity, you're talking about operating businesses, okay? Or what you're trying to measure is the operating results of a company rather than asset values. There's nothing wrong with doing that. It's just a different skill set, okay? So when
You
we're,
don't take the whole thing as a whole rather than
you do, but just
you
imagine
just
that
look at
you were
the-
gonna buy Google and it was a private company, you spent half your time valuing its assets and half its time valuing its operations. That'd be a pretty silly allocation of your time, right? So, there's such a huge difference between the value of Google,
Yeah.
right, as an entity,
Right.
as a market value, and the value of its assets, okay? So, you know, I think what you try to do is you try to say, okay, well, we think this company's worth about $100 million, right? And they have about $2 million worth of asset value in terms of plant, property, and equipment. We'll spend about 2% of our time making sure that that $2 million estimate is right, but we'll spend 98% of our time looking at the cash flow and the other, operating results, which constitute the bulk of the entity's value. Generally, when you're looking at a company, you're not looking at the value of the asset. Generally, when you're looking at a company, you're looking at the value of the cash flow. That's not to say that there aren't instances where a company has such little value, okay, such little cash flow, right, that you're looking at basically a sum of the parts valuation, right? If you just bought this company, you ever see the movie Other People's Money with Danny DeVito, right? They bought up the company, shut the company down, took the money, they had an overfunded pension, pulled the money out of the overfunded pension, right? Sell off all the factories, sold off the brand name, made a fortune, right?
I thought that was what PEs do as well.
What private equity companies
Yeah.
do? Private
As
equity
well,
companies.
I mean.
They can certainly do that, but I think what you'll find, and this is what you guys will discuss tomorrow, is that generally when you're doing an LBO, buyout, right, what you're finding is that there is a discrepancy, right, between the debt value of a company and the market value of the company. So in other words,